started at 16, you started investing into this kind of value world. As we've talked about, the markets have changed. Buffett hasn't been keeping up with the markets in the last 2 decades, as you said. So where do you see the state of the market and investing today? I mean, it seems like it's a pretty dangerous world right now. What's your kind of big worldview that we can kind of dive into?
Absolutely. I think in general, we've reached a point where interest rates are not going to go through what they did in the late 70s, where there's going to be a new Fed chair after Powell's gone, and he's going to say, okay, we need to kill this environment of artificially low rates. I think this is not artificially low. I think this is it. The financial system as it's built today is not equipped to normalize rates where they're like 3 or 4 or 5%. 2 reasons. One, we don't live in a vacuum. America already pays the best rate to its lenders.
The highest interest rate.
Absolutely.
Yeah. So most of the world's negative already, and we're still paying a positive rate.
Exactly. Most people don't think about that. You're not finding just stocks versus bonds. You're finding other countries. That's why when Trump was around, he was like, lower it to 0. What's going to happen? Everybody is at 0.
Right.
So, but obviously, being the reserve currency, you have other things to consider. So I think that's important. In December 2018, the Federal Reserve signaled that their autopilot rate hikes are not over. And they raised rates to 2.25. And what happened? The market totally rejected that. It says enough. 2.25, that's too much. 20% drop in 1 month for the S&P 500.
Right.
Mutual called all these banks. It was like, are you all right? Are you capitalized? Yeah. Nothing was wrong. There was nothing wrong except interest rates were 2.25, and that was just too much.
Yeah.
And so after everything, and now with an entire generation of people recapitalizing on their mortgages, all these corporations that are banking on low interest rates, it's over. In this kind of environment, I don't think interest rates are artificially low. I think they're artificially fixed. They're fixed to these low rates because the world is just based off of it. That's it. Corporations, individuals, households, pension, the whole thing is built under this environment. And so the Fed is not even thinking so much about interest rates policies, it's thinking about yield curve control, it's thinking about other concepts of how to operate in this world. And now when you and I operate in that world, we need to think about that as well. For example, companies like Amazon or Apple, etc., they have better debt than the United States government. And so they're almost quasi-bonds, quasi-companies. They're growing faster than many other companies, plus they're safer. That's why their PE ratios can go to 30, 40, 50, and the traditional investors, those that say, Bitcoin is worthless, the 80-year-old value investor that likes to look at things like Benjamin Graham looked at them.
Right.
After the Great Depression, when you stripped something to the bone, you were like, okay, what is Mark worth? That's the skin, that's his shades, that's his teeth. What is he worth? I want a liquidation. No, you have to pay a premium in today's world because there are very few bankruptcies and companies are growing really fast. So you need to be with the times. If you try to look for companies at a 15 PE ratio like the standard, you're not going to invest anything.
Right, you're never going to find it.
Exactly. So it is dangerous because you're paying higher multiples for companies, but in the grand scheme of things, if you look at all of the stock market, at real estate, at other asset classes, it's all expensive. We live in an expensive world, and we have to invest with this thing in mind, that anything we do is going to be expensive. A deal or something that's like cheap is either in a boom bust industry, for example, mining, where you can go like down 80% and then up 400, 500%, that's fine. So if you live in that world of the boom and bust cycles, that's fine, but you can't have the majority of your money in that.
Right.
It's not sustainable. You can't operate a full 40 years worth of investing from 20 until 65 just on a roller coaster.
Because then your retirement's based off of luck. Where are you retiring in that boom and bust cycle?
I agree.
So you can't have that.